Well, thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. And the talking point today are the views of Mr. N Jayakumar on a bunch of things related to the markets and investing. Jake, so good having you. It's nearly the start of the year, if you will. Thanks for joining in today.
Thank you for having me over.
No, the pleasure is ours. Jake, it's an interesting time in that if the markets at large believe that inflation was a thing of the past, then the recent jobs data, the Fed commentary, even the RBI leaving the door open for another hike, seems to be now making the participants forcing a participant to make a bit of a pivot. Now, how important do you think this variable, in light of tomorrow's inflation data as well, is for the overall scheme of things around equity investing?
The way I see this is that the markets during the period when interest rates were being hiked actually had overcorrected. People saw the correlation between a hike in interest rates and being negative for equity markets. That's the kind of finance 1.0, if you will, that gets played out. So I think people overcompensated. FIIs, for instance, are at 2008 levels of exposure in the Indian markets. These are like decadal lows in terms of their holdings in Indian stocks. It's true for surveys that have been done by people like Merrill Lynch and others, who will tell you that the pessimism around stock markets has never been higher. About equity markets has never been higher. So people are prepared, over-prepared, protected, insured, if you will, against a recession in the US, decline in emerging markets, overvaluation in India. These are all consensus themes to some extent playing out. Everyone will tell you that the Indian markets are optically overvalued. Everyone will tell you that the institutions have had redemptions and they're selling out. So at one level, we aren't really operating with any new metrics. But if for whatever reason, at any point in time, the pace of rate hikes reduces or the rate hike itself sort of stops, you could have, to my mind, a very, very sharp upward move in the markets. And I think the markets may well be gearing themselves up for this.
Okay. And this is a view, not just the global markets, but you reckon India might follow suit as well?
I think it's largely an India market view. I think the most consensus call in recent times was that the best place to invest from a geopolitical perspective, from manufacturing perspective, etc., for a multitude of reasons that people on your channels have waxed eloquent on, was India. But it's also equally true that India was an overvalued market in terms of historical numbers, etc. But more recently, I think with the passage of time, forward multiples of the Nifty have to some extent reverted closer to means than before. They are slightly overvalued, but this is where institutions like especially the overseas ones have been selling what they own, which is financials, technology, etc. And the time may well be right now for a bottoms of stock pickers market, where that which is unloved, unfancied, unowned, underowned is what's going to be are going to be the leaders of the next move.
Okay. Now, before I dwell on that, Jake, just one quick follow-up here on the larger macro. Usually, what brings the markets down is not an element that you and I or anybody has completely thought of, but it's a bit of an unknown. Now, I can't ask you to predict the unknown, I understand, but is there something within the knowns, which is a small thing, if it snowballs into something larger, could kind of derail the party, if you will? Is there something that you're looking at and hoping that it doesn't worsen from where it is right now?
Well, the Adani episode more recently, and people don't even want to talk about it on channels, but recently threatened to derail much of the sort of secular growth story, if you will. But the markets, even in 2 weeks, have sort of already polarized one with the rest of from the rest of the market and said the group will handle their affairs the way they need to. The market will handle its affairs the way it needs to. So I think at some level, this is got decoupled. Where the coupling could have happened is in terms of PSU banks. But I think the way PSU banks, LIC, etc., have come forth and talked about how their exposures have been within prudential norms, and ultimately ups and downs are part of life, write-offs are part of life, if there were to be a write-off, and I don't even believe there will be. as banks have indicated that the exposures are well within reasonable norms. So I think the markets have been more protected. In fact, if there is a group of investors who are exposed more to this Adani group as otherwise, are probably overseas equity investors, where the MSCI index rebalancing made a lot of passive funds become shareholders in Adani group of stocks. It could also be debt holders in various Adani group companies, who may be exposed. But I don't believe that a lot of the debt now it's below 35% of the overall Adani debt is actually with Indian banks. I think banks are well secured, and I think the group itself has multiple marquee assets to be able to address this issue. So, and there's not too much of, should I say, redemption pressure coming over the next 12, 18 months in any case. So, both in terms of their getting time to raise equity in various group companies, whether it's ports, cements, airports, etc., or it is refinancing of debt and the scenario and the markets improving for that, there is time for both that is adequately available. So I would not, at this particular point in time, say that there's any one particular event which this could have been a big event because the group had a market cap of close to 250, 270 billion US dollars, their debt of close to 30, 32 billion dollars, etc. But that seems to have navigated itself well over even 2 weeks. Yes, the IPO didn't happen or the FPO didn't happen, but that's par for the course. At one particular price, it didn't happen. It may happen at another price, and it may happen as a QIP, not as a private placement, not as an FPO. But fundraising, they will do. They may have to do it at a different value. That's the only way I see it.
Just a quick follow-up here before we move on to the larger things. So let's assume that this is a bit of a protracted event, if you will. And like you said, they might have various options at fundraising, asset sales, what have you. The drawdown that has happened in even some of the institutionally well-owned Adani Group stocks has been pretty sharp. Now, do you reckon, and we've seen instances of some smart money flowing into some of the names like Ambuja, Adani Ports, etc. as well. So my question to you is, now that you said that the Indian markets don't get derailed from this, the broader retail sentiment, as well as some of the more decently valued stocks within the group as well, do they come back, or does this usually take time? Because you would have seen such instances happen in the past as well with your experience. What do you think happens in this?
Well, the sort of size of the problem, if you will, seems to keep, is bigger every time because the markets get used to a particular size. But I also think that the maturity of the Indian markets needs to be talked about. I mean, I don't want to talk on specific stocks. I've alluded very generously to the fact that they have marquee assets, whether it's ports, cements, airports, etc. So I'm not particularly worried that the group will have either a problem in terms of liquidity in the short run or a problem in terms of servicing debt. Yes, they may not be able to raise equity in a hurry at the valuations that they thought, but they may have to raise it at lower valuations. And they may have to do this, as I said, through a different instrument, maybe a partnership, maybe a strategic tie-up, etc. So I don't think that per se is an issue. I mean, ultimately, equity is equity. If it came into the group, it will help matters. I think the bigger thing here is that perhaps a lot of their expansion plans. See, please understand, I think India needs a number of these Adani kind of groups, which means groups that take risk, groups that are willing to put out the entrepreneurship, beacon, if you will, carry that forward, groups that have been able to, put on capital assets, because the private sector has been almost remiss in not actually taking up the load, which has been largely borne by the government space, the government sector. So I think from that perspective, the fact that some of the refinancing challenges, if you will, if not risks, challenges of Adani may prevent it from, expanding as much or rolling out as many new enterprises or ventures that they originally may have envisaged. And to that extent, I think this will derail private sector capex up to a point. But hopefully other groups will take up the slack and move forward. Yeah. But India definitely needs this entrepreneurship drive, if you will. And much like the entrepreneurship which got fueled by the startup economy over the last 5-7 years, similarly or so too was the capex economy, if you will, if I can call it that, getting stoked by groups like this. The Tatas have a few plans. Air India has been taken over. There's expansion in steel. There's expansion in the EV space. So other groups are doing it, but this group was very visibly at the sort of in pole position in terms of leading capex and leading investments in the country. And to that extent, I think it's a bit of a setback. That pace may well will well decelerate, if not get dramatically impacted.
Okay, small decelerations maybe, but overall, if the other groups pick up, then things should be okay from a capex drive in India as well. So thanks for that perspective, Jakes. Usually people say that these capex cycles, when the turnaround happens, is the long cycle, 7, 8, 9 years. What's your thought around this particular capex cycle in India? It's about 1.5 years, 2 years old, if you will, wherein we've started seeing some bit of capex. Do you reckon there's a possibility of this being long lasting, and therefore do some of the names or do some of the themes which benefit out of a capex cycle, optically seemingly expensive currently, do you reckon that that's a theme that you would want to look at seriously?
I'm actually extremely bullish on the manufacturing and capex theme playing out. Especially 1 year pre-general elections to 2 year post is when the greatest amount of investments are made. So in this period of 2023, 24, 24, 25, 25, 26 is when I see dramatic government push. The PLI schemes are rolling on. China Plus One is rolling on. There's Taiwan Plus One. There are manufacturing behemoths, if you will, every week virtually talking about how they're going to move certain things to India and how India will, over a period of the next 10 years, 15 years, provide them 20-30% of global supplies. The Indian rupee has been nicely weakening, so the export thrust is on. There will come this inflection point when exports suddenly pick up. And there are cases of small Japanese companies in the hydraulic space, in the machinery space, moving capacities out of Taiwan into India, moving capacities out of Far East into India. There are textile units who are now re-looking at India vis-a-vis Bangladesh, Vietnam, etc. So this movement is there. Maybe these are at a point in time. I mean, you should be in a position to say that this movement has become a bit of a sort of a snowball kind of thing for it to really be visible to the naked eye, in a manner of speaking. But this is the movement that will generate employment, will add to the bips on the GDP, and will give long-lasting, because you see, the new economy has been throwing out jobs. The new age companies have been laying off people. So the slack has to get picked up in a numerical sense. I'm not saying the same people, instead of being programmers, will start, laying roads or whatever. But I think the slack has to get picked up somewhere. So, and if you look at even this article written by Russell Napier, which talks about post-World War I, World War II, most governments that had borrowed huge amounts of money could only repay by stoking the economy, improving to GDP, improving to employment, improving to tax collections, and therefore paying down the debt that they had taken from their, in terms of the government borrowing. So from that perspective, I believe that the PLI, the weakening rupee, the capex here, multinationals moving in, etc., is all part of a grand design, a collage at best right now, but it will emerge into a picture over a period of the next few years. And I'm extremely bullish on this.
That's very interesting to know. I heard you saying one of the second answer, Jakes, that so this is of course a theme that is love. I heard you say that what is unloved might also be pockets to look at. When I scan back to 2022, what was unloved the most? And I know 1 year is a short time frame, but I'm still using that as a barometer. That suddenly the darlings of 2020-21, which is IT services, went off the boil. New age platform companies completely went off the boil. Is starting to make a bit of a comeback, Jakes. Do you see merit in this? Or are you a bit skeptical on IT services and platform? They are diverse, but I'm clubbing both of them right now for the sake of a question.
Stocks may move. I'm specifically ignoring both these spaces.
Okay.
Personally, I mean, just as a disclosure, I believe that the integrated metals play for a long period of time, steel companies have been getting 3 and 4 and 5 multiples on EV/EBITDA, while cement and a whole bunch of other industries have been getting middling double-digit multiples, low teens to mid-teens, EV/EBITDA multiples. I think the time has come that the integrated metals players, already the metal space has got consolidated. The first sign of an upward move in EV/EBITDA multiples or a PE multiples is essentially the consolidation in the industry. So now the industry is getting more and more consolidated, at least domestically. With deglobalization, there are enough incentives for people to start producing, because there's consumption in India happening as we speak. As part of the overall deglobalization theme, there are taxes that steel importers steel exporters face when they export to the US, for instance. If you add these themes, so the metals or the steel space specifically is unloved, underowned. Number two, the pharma space. I think pricing pressures are now, if you see 2 or 3 of the last few results, pricing pressures are decidedly on the lower side. API prices have come down. The PLI schemes in India are kicking in. So production of PNG, etc., is now possible in India. So people will end up with sufficient, PLI incentives to actually produce some of these, add to their integrated, chain or cycle, if you will, and with the, to the extent that a lot of these products, especially the generics, are exported or formulations are exported, you will have the scenario where, again, the weakening rupee, the export story, and PLI, etc., could affect pharma in a big positive way. Most of these stocks, by the way, are at 52-week lows, barring maybe the industry leader, 1 or 2. Most of them are at 52-week lows, and some of these, even at 52-week lows, have produced record quarterly numbers. And if logistics costs, that means transportation costs, if input costs, etc., and pricing pressures on the end product are down, are on the wane, then you're talking about margins stabilizing to improving, volumes going up as evidenced by some of the recent results. And I think you could have a very interesting set of 1 or 2, 3 pharma companies, large global players, which could actually merit consideration here. Number 2, as I said, the manufacturing space, which is the engineering and engineering export space, and where the capacity utilizations are close to 100%, and now new capex is being set up for increasing capacity. And more importantly, the integrated steel players are some of the unloved spaces that I kind of like.
Got it. Just my final question, because we didn't have a chance to talk to you around the budget, but there was some 3 or 4 headline themes, though the budget is not meant to be a headline grabbing event anymore, but the thing around insurance and the changes thereof, or for that matter, the whole infra push, in addition to the capex that we speak about any which ways, and railways suddenly and the kind of spend there. Did anything stand out in the budget for you from an investment perspective, or from a macro perspective, as the case may be?
I think the budget just added to the narrative that was already in play, where manufacturing is going to be given a push, where risk taking is going to be given a push, and there are sufficient incentives, which means whether in terms of sales tax benefits, etc., which come back to you as a result of productive linked incentives, if you will, or investments, if you will. And to that extent, the way I see this is that the budget only reaffirmed what we were already aware of, but put that out more starkly in a 2-hour speech, which basically said that we're going to push, and the only way out of this thing is for India to become the oasis in a desert, if you will. I think if you add to the fact that geopolitically we've been able to navigate our way by having good relationships with different parts of the world, whether it's the Middle East, whether it's the US, or it's Russia and Europe, as always, we are able to pick on marquee assets, whether in Lanka, Israel, etc., from a longer-term strategic perspective. And the fact that India offers the ability for people to invest, hundreds of billions of dollars. Hopefully, the only thing missing in this entire piece was a stable regulatory regime. And if you don't have any of the past, the retrospective taxes, etc., which I think is a thing of the past, you're talking about a golden period of the next, I would say, few decades. And that may have just begun with India leading the charge on some of these. India will always be an elephant that will move slowly. But when the move happens, it'll be difficult for you to, reverse that as well. So from that perspective, I'm very optimistic. and I think investing will be a good thing. But you may want to be a little nimble in your portfolio allocation, because things like tech, etc., were the favorite, points of hiding, if you will, which may not necessarily be the case today.
Got it. Great talking to you as always, N Jayakumar. Thank you so much for your time, and frankly, look forward to maybe having you a bit more often than what we do currently.
Absolutely. Look forward to the invitation. I'll be there. Thank you.
Thank you so much, Jakes and viewers. Thanks for tuning in.
Thank you. Bye-bye.